Okay, so welcome to today's lecture. Last week we stopped with credit risk. We've talked a little bit about market risk, and now the second, probably the most important risk type you can find in a bank is credit risk. It's important to note that obviously credit risk matters a lot for banks, but actually credit risk is also a risk type that is quite frequent in industrial firms. And I've only put energy and utilities suppliers and utilities companies here down at the bottom. And you can imagine that every time you have credit outstanding, you can demand payment from a customer, you have credit risk. And we make a distinction between two types of credit risk, in the strict sense and in a broader sense. Now, in the strict sense, credit risk is the risk that a payment will not be made. A customer defaults, and you will have to write off all of your outstanding debt. In credit risk in the broader sense, you can see it still needs some polishing here. Credit risk in the broader sense means that the probability of repayment diminishes. And this is a slight but important difference, because in many cases you will try to price in and to price credit risk. Small example, if you want to grant a loan to, say, Daimler or BASF or BMW, you will have to look at the credit risk and the probability that your loan is repaid. Now, it doesn't make too much sense to put a price on default and on credit risk in the strict sense, but it makes sense to say, okay, if the probability is 1%, I will only demand a 1% markup. If the probability is 5% that the company will default, okay, I will need to ask for a 2% additional interest on my loan, and this is how the risk premium increases and increases, conditional on the probability of default. And you will always find credit risk in the broader sense, because each and every company has at least a minuscule risk of default. Now, credit risk in the strict sense is quite infrequent. Also because in many cases you are able to recover some of the money that has already been lost. And recovery rates are actually 5 to 10, sometimes even 20%. So even if the company defaults, there's a small percentage of money that you might be able to recover from the loan that is already written down. Okay, so this is the distinction between credit risk in the strict sense and in the broader sense. There is also one important aspect of credit risk that has become more and more important, especially during the financial crisis, and this is counterparty risk. Who of you knows what an OTC contract is? Over the counter. Can you explain what an OTC contract is?
Well, it's an over-the-counter contract.
Yes, and what does it mean, over the counter?
Well, that it's not regulated or standardized. As you
Yeah.
can see, some regulated derivatives or so.
It's a financial contract that's not traded on an exchange, but the conditions of this contract have been agreed upon by the two parties who want to engage in this contract and want to sign the contract, and it's negotiable. So both parties can agree on specific terms in the contract, and it's not a standardized financial instrument, but it's an OTC instrument. It's not traded on an exchange. So this would, for example, mean we engage in a swap contract, which could be based on, say, let's make a foreign exchange swap. I'm paying you 1 million euros, and you will have to pay me, say, $900,000 at the current exchange rate. So this is a currency swap. You might be able to buy such a swap on an exchange. There are some standardized contracts for that. But if we want to agree on different conditions, we do an OTC contract. And this is something regularly done by business in a B2B context between institutional investors, especially when the underlying instrument is not a standard instrument like an exchange, a foreign exchange rate, but when it's a different trigger event. And in these cases, if I pay you 1 million euros, I want you to pay $900,000 back to me. But in case you default, I will have a problem as a contract partner in this OTC contract. And although I have not given you a loan, I'm counting on you to pay your debt to me as part of the OTC contract. And I might already be in a problematic situation, even if I've not yet paid out the 1 million euros, because we have agreed on an OTC contract. I'm counting on you to pay me $900,000 in 1 year, and I thought that I was hedged against the currency risk stemming from the euro-dollar exchange rate. And after 6 months, for example, I still think I have no currency risk, but suddenly my counterparty in this OTC contract defaults, and I'm left standing without risk insurance. And I again have this risk exposure to the currency rate. This is counterparty risk. Does any one of you know in which real historical situation counterparty risk became an immense problem? This is the CDS and AIG case. During the financial crisis, American International Group, the world's largest insurance company at that time, was also the largest, by far the largest counterparty in the CDS market. CDS contracts are credit default swaps, and it's basically an OTC traded default insurance you can buy without having to give out a loan. Investors can invest in credit risk, and the counterparty gets credit insurance. And AIG at that point was the main counterparty in this market with an exposure of, I think, close to $1 trillion even. So it was enormous exposure. And they only had CDS contracts written in one direction. They had written CDS contracts, and they were the insurer, and they had given out credit insurance for CDS contracts which were based and which had banks as underlyings. And if several banks had defaulted, AIG would have gotten into trouble. They got into trouble. And if AIG had gone bankrupt, a lot of investment banks would have had severe problems because suddenly they were without credit insurance. This is why AIG was bailed out by the US government, because the US government, I would say correctly, saw that AIG was systemically relevant. If AIG had gone down south, probably the financial crisis would have been even worse than it actually was. So this is counterparty risk. You engage in a OTC business contract, and you think that you can depend on your counterparty to pay the payments they are due. But in case the counterparty defaults, you cannot force the counterparty to pay their payments. You have a question?
Why didn't the government just aid the banks that AIG owed and let AIG go bankrupt?
Well, because it was easier to bail out AIG with a couple of billions than having to pay $1 trillion. It's a simple calculation. They were, they had written CDS contracts, I think, in the trillions of dollars, in the high billion numbers, and it was easier to bail out AIG than to pay up for all the CDS contracts they had written. Especially if that had been the solution, the publicity effect would have been even worse. Let AIG go bankrupt, we can pay up for the remaining CDS contracts. That would have been no good idea. Yeah.
Is there any kind of regulation for CDS contracts?
Now there is. During the financial crisis, there weren't. One solution for this problem is the establishment of a central counterparty, of a CCP. So you are trying to establish a central counterparty that takes up some of the functions and roles usually an exchange would take. In a regulated market with an exchange, you don't have these problems because the exchange will guarantee all payments. The trading is anonymous. All trading is done via the exchange. The exchange, for example, the stock exchange, for example, if it's a stock market, the stock exchange will guarantee all payments. But the stock exchange will also punish all participants that do not pay up. And if you are not compliant with the stock exchange's rules, you will be dropped from the market and dropped from the exchange. This is one of the major functions the exchange takes up. So in this case, it's not a regulated market. You don't have an exchange. And after the financial crisis, regulators tried, and they did install a central counterparty to make this market more transparent. And also because this is a B2B business in the end, it means that at that time, no one was really aware who had written CDS contracts in which amount based on those notionals, those underlines. Yeah.
Yeah, with the additional regulations, is CDS still counted as an OTG product? When
It's still OTC, yeah. Yeah. Because it's not standardized. Yeah. Yeah?
Couldn't it be regulated like insurance companies in Germany, if it's the same?
How?
Via Eigenkapitalquoten or stuff like this?
I mean, there are specific rules in place for and regulations for CDS contracts and this type of business, and actually this is the prime example, and I would say the only example of an insurance company that became systemically relevant, and it has become the prototypical example for regulators with which they justify the systemic regulation of insurers. Nowadays, large insurance companies, they found themselves on the list of globally systemically important insurers, and these globally systemically important insurers, they face tougher regulation, and tougher regulation entails higher capital requirements, and these capital requirements are in a specific manner calculated based on what the regulators deem to be non-insurance activities. So this is one part of non-insurance activities. And if an insurance company engages nowadays in non-insurance activities, or what they also, the exact wording is non-insurance and non-traditional activities. And in case an insurer engages in these non-insurance activities, they face higher capital requirements and higher capital charges. Yes, that's one way to regulate this. Okay, so this is counterparty risk. It has become quite important during the financial crisis. Here you can see some examples for this. This is especially important when it comes to OTC traded derivatives. And CDS contracts are credit derivatives, a type of credit derivatives. Okay, and what could happen? Well, the counterparty can default, the issuer can default. Might be that they fail to perform while the counterparty is already paid. We can come up with different situations in this example. For example, you cannot pay the full $900,000, you default completely, and so on. You pay up at a later date. Yeah. And here you can see that this has been solved to some extent via the inclusion of a central counterparty. And this is has been done in the CDS market. Okay. Just to clarify the word clearing, because you can often hear this in the context of stock exchanges and OTC markets. The central counterparty takes over what is called the clearing in the market. And what is clearing? Clearing is the entire process of settling a financial transaction. So even if you buy a stock, if you engage in a derivative contract, both parties need to know what type of payment is due on which date, where should I send the money, what type of account is it, and this information is included in the clearing, the settlement of the financial transaction. So the determination and settlements of mutual claims, liabilities, the delivery of stocks, in some cases the delivery of raw materials and resources, if it's physical settlement, which is quite rare these days. In OTC trading with central counterparties, the market participants do not enter into transactions directly with each other, but they always deal with the central counterparty. So in this case, the central counterparty can, of course, solve this counterparty risk problem we usually have in an OTC market. Here you can see an extract from the Wall Street Journal, US to take over AIG, and actually $85 billion bailout capital injection. This was a shock to insurance. And you can still feel this, because nowadays all insurance regulators also think from a macro-prudential perspective and think that insurance companies can become systemically relevant. Before that, you were laughed at if you ever brought up the idea that an insurance company could become systemically relevant. There are distinct differences between insurance companies and banks that usually lead to the conclusion that insurance companies cannot become systemically relevant. For example, if you take a usual non-life insurer, if you, for example, had cars and you had insurance with Allianz, and now the news would break out that Allianz is close to bankruptcy, would you care? No. You would simply go to the internet, you would look for a different insurance company, and you would switch insurance companies. The competitor would immediately pick up the business left by Allianz, and there would be no situation like in banking where you have a bank run. So insurance companies can go bankrupt, and there should be no immediate effect on systemic relevance and the systemic stability. Now this is a different situation, and this is why AIG became so famous in these days. Okay. AIG was a major seller of credit default swaps, and AIG's millions of insurance policyholders appear to be considerably less at risk. So this is also why some colleagues in the US have always said that it wasn't AIG's insurance business that got AIG into trouble. It was the fact that AIG was a trading company with an affiliated insurance company. So they used the money from the insurance business to engage in heavy trading. And that's what got them into trouble. Okay. Also, a small extract from business, an annual report, in this case from the DZ Bank, which is one of the large mutual head institutes in Germany. And you can see that they have credit risk volume of 308 billion euros. They had that at the end of 2012. Okay, so this is usually the largest part when it comes to risk exposure of a bank. The next risk type is liquidity risk. Liquidity has two facets. First of all, you can think of liquidity as the ease with which you can buy or sell an asset. For example, this pen is not very liquid because no one is interested in it. It's used, it's not standardized, so no one is willing to buy it. And this will lead to a large discrepancy between the buying and selling price, the bid and the ask price. So we have liquidity of assets. And we also have liquidity of firms. A firm can also be liquid. And a firm is liquid if it's able to pay all its outstanding current debt without violating contractual agreements. And how can a firm be liquid? Of course, if it holds enough liquid assets. So asset liquidity and company liquidity are linked via the availability of current liquid assets on the balance sheet of the company. So what happens if you're not liquid? You get insolvent, you go bankrupt, and in these cases, insolvency is triggered by the company's inability to meet the company's short-term payment obligations. This is liquidity risk. If you're not able to make sure that you can pay all your debt that is outstanding and that is current, you face the risk of insolvency, and this is liquidity risk. It's not exactly like credit risk or like market risk, because you can also go bankrupt if you do a bad liquidity risk management, even with a low and small risk exposure. It's the same with you as a private person. You might own a house, you might own a car, but if you take all your cash out of your bank account and you pay for your vacation, and next month you have to pay for your rent, and you don't have any cash left on your bank account, you have a problem. Even though you have a house, you have enough liquid assets probably. And if you do a bad liquidity management and liquidity risk management, you can face bankruptcy even though your risk exposure from credit and market risk is small. So usually the liquidity of an enterprise, of a firm, is understood as its ability to fulfill all due obligations at a given time. The simplest solution for this is to retain enough cash and enough liquid assets on the balance sheet to make sure you can fulfill all your obligations. And why is this not the best solution? Just hold enough cash.
High opportunity cost.
Yeah. The opportunity cost of holding cash is high because you cannot, the cash is not working for you. You can invest the cash and the liquid assets. So this is a problem. If you delay, if you see that cash is short, and if you have liquidity problems and you delay the filing of insolvency and bankruptcy, you will face penal charges. In German, this is called Insolvenzverschleppung, and it's punishable under penal law. It's probably the same in all countries, that if you try to hide the fact that you are actually bankrupt, you will be punished under penal law. Okay. So what is liquidity risk? It's the risk that a company has insufficient liquid funds to settle all short-term or current liabilities. Liquidity risk can arise in the company in two ways. On the one hand, there can be an unexpected, strong outflow of liquid assets. So your available liquidity decreases more than you had anticipated. The second source is that your incoming liquid assets decrease. You thought that there might be liquid asset, more cash coming in, might turn out that cash is not coming in. And it might also be that you misinterpret the maturity of your liabilities. If you thought that all these liabilities are long-term and they turn out to be short-term, you might have a cash and liquidity shortage. And this is liquidity risk. It could also arise as refinancing risk. That means that, for example, if you have a loan and the loan matures, you need additional cash to pay back this loan, or you get a new loan. And if you're not able to secure a new loan with a bank or with a lender, then you have refinancing risk. This is also part of liquidity risk. It's, yeah?
In what case would I expect a liability to be long-term rather than to be a short-term one?
I would assume that a long-term, if you think that a short-term liability is long-term, it might for banks it might quickly arise, this problem with the deposits, because usually you know that deposits are short-term debt, but from experience you know that a certain percentage of the deposits are left with the bank even though they are short-term. This is what basically lending and commercial banking is based on. The fact that although you have you have short-term deposits. You can count on the fact that these deposits are left there with a certain probability for a longer maturity. So this is the easiest example where you make wrong assumptions. They might not be, well, most of the time this assumption is true, but in case of a bank run, this might force you into bankruptcy. So this again here shows you why liquidity risk is particularly important for banks, because maturity transformation and the fact that banks make most, or used to make most of their business via maturity transformation, makes the balance sheet of a bank inherently unstable. They always have a maturity mismatch, that you have long-term assets, loans, and short-term debt, especially deposits. So you always have the risk of a bank run and an unstable funding situation with the bank. Okay. For insurance companies, this is not true. Why? Because insurance companies have a steady inflow of cash via the policyholders' premiums. And you can count on premiums coming in each year or each month even, and this makes liquidity management much easier for insurance companies than it's for banks. Okay. And last but not least, we have operational risk. Under the Basel II regulation, regulators first thought, okay, we have to come up with different risk types banks need to account for, and they thought, okay, let's start with credit risk. The second risk type is market risk, and what is left is operational risk. And you come up with losses that can arise from exogenous influences, for example, natural catastrophes, and sometimes endogenous risk sources, for example, own employees, internal processes, the companies, the bank's IT, and these sources of risk lead to operational risk. And especially in the first case, natural disasters, catastrophes, unexpected major losses can occur if risk management has only monitored and controlled the business-related risk. So market risk, credit risk. But it might simply be a risk that there's a heavy rainfall and your company headquarters is flooded. So this is a risk for you, and this is an operational risk. And as I said, this was first defined in the Basel II regulation in 2006, 2007, and banks were forced to account for operational risk just like they do for credit risk and market risk. This has also been introduced into German law. It's now part of paragraph 269, section 1 of the Solvenzverordnung oder Solvabilitätsverordnung, the solvency regulation that governs the rules for banks and financial institutions, how they should calculate their solvency capital to cover risks on their balance sheet. And how is operational risk defined in 269 solvency regulation? Operational risk is the possibility of losses that can arise from inadequate or failing internal procedures, systems, people, or from external events. This definition also includes legal risks. I always say this is the bucket of all risks that cannot be inserted into credit or market risk. Everything is an external event. I could even say that if a counterparty defaults, this is also an external event. This is credit risk. But here we think of major catastrophes, natural disasters, riots, civil wars, and this. And you can see it's a mixture of different risks. It could be the employee who steals from me. It could be the failing IT system. It could be a natural disaster. And this is operational risk. Operational risk is usually characterized by very rare risks and rare events that come with high losses. If a natural disaster hits you, it's not 1,000 euro, it's probably up in the millions. So these are the large freak events that cause major losses to you, but which are extremely rare and thus hard to measure. One note of caution, for Solvency II, the GDV, that is the main lobby group for German insurers, they specified in their discussion paper for Solvency II operational risk. This is operational risk under Solvency II from the viewpoint of the German insurers. So you have to note this is the industry opinion. They say that in German Reputationsrisiken, Risiken aus strategischen Entscheidungen sowie die im Rahmen von Versicherungsprodukten aktiv übernommenen Risiken fallen nicht unter die operationalen Risiken. So they make a small distinction in contrast to Basel II. They define operational risk just like Basel II, but there's a slight difference. For example, they say reputational risk and strategic risks are not part of operational risk. So, slight clarification, slight distinction here when it comes to insurance companies. But actually, under Solvency II, they have the same risk types. They have market risk, credit risk, and operational risk. And market risk and, well, of course, credit risk is slightly different. They have actuarial risks there. Okay. As I said, most important difference is it's quite rare, it's difficult to measure, and it usually comes with a high level of loss. With the definitions under Basel II and operational and Solvency II, operational risk is no longer defined as simple the residual value to the different types of risks. So it's not just defined as every risk that is not market risk and not a credit risk, but it's a positive definition. But as you can see, it entails and includes a large set of various risk types. Okay. Again, you can see general business risk, reputational risk, and legal risks. It's also the question if you want to include legal risk or not. I usually would not count legal risk to your operational risk. It's part of your general business risk. If you take, for example, Deutsche Bank, this is not an operational risk. This is part of their strategy. They do a high risk strategy, and then as a result, they face higher legal risks. Okay. Small example, the fall of Barings Bank. And when you take Barings Bank, you can see that actually several risk types are connected with each other. You have, does everyone know how Barings Bank collapsed? Simple. They had a rogue trader. The rogue trader was not controlled sufficiently. He accounted for all his losses in a different account. He was promoted, was able to trade on a large account, and then he lost a couple of billion pounds. And when the great Hanshin earthquake hit Kobe, Asian markets plummeted, and the rogue trader was no longer able to hide his losses, and overnight Barings Bank was bankrupt. And you have a connection of several operational risks here. First of all, you have the lack or the failure of internal control procedures. No one in risk management was able or was willing to see the fact that someone was engaging in high risk strategies and was piling up losses. Second, illegal behavior of an employee. And finally, an external event, the Hanshin earthquake in 1995. And you have three different operational risks hitting the bank at the same time, causing bankruptcy. Okay. So these are the most important types of risk: credit risk, market risk, operational risk. When you have different industrial firms, and we'll see this to some extent in the financial risk management class next semester, in different industries you also have industry-specific risks. But for banks, credit risk, market risk, and operational risk are the most important types of risk we have. Okay. Now let's turn to risk measurement. At the end, it's all about P&L. It's all about profits and losses, and financial risks are usually, most of the time, almost 100% of the time, measured and estimated via the loss distribution or the P&L distribution. In case you're only concerned with the losses, you take the loss distribution. In case you also want to have a look at profits, you take the P&L. The view that the loss distribution of a portfolio and key moments of this distribution, that they are sufficient to adequately measure risk. This view stems from the fact that what else should you use? If you deal with financial risk management, you are focusing on a monetary, on a pecuniary measurement of risks. So you immediately turn to profits and losses. Loss distributions can be grouped. You can aggregate loss distributions. For example, if you have a risk X and if you have a risk Y, simply add them and you get the aggregated position. You have the portfolio position. You can model netting and diversification effects, and you can compare loss distributions. In the risk management class, we have some examples in which we can see, okay, you can also try to measure risk in a different way, but at the end, you will always come up with the idea of using profit, P&L distributions or loss distributions. Okay. You have two disadvantages when you use loss distributions. The first disadvantage is that to estimate and to model loss distributions, you need data. You need a lot of historical data, but actually that's a necessity you will always have. If you want to model your risk and you don't want to do fancy assumptions on your data, you need historical data. So this is a prerequisite in all alternatives as well. And the second disadvantage is that it involves a large model risk. Let's make a quick example. If I say, okay, the historical losses we have are like this. And I would say these losses are normally distributed. You can use a Gaussian distribution. In English, it's normal or Gaussian distribution, Gaussian Normalverteilung. Then losses would look like this. What is model risk in this case? Model risk has some facets, some different facets. First problem could be, I'm using historical data to forecast the future. BAP. Doesn't work sometimes. You have historical data and sometimes you cannot do a forecast into the future because the distribution changes. First problem. Second problem is maybe the normal distribution is not adequate for modeling these data and I should use a Stevens t-distribution. So I've picked the wrong model. Or it's the correct model, but I still need to estimate two parameters for the normal distribution. And in case I use an inadequate and the wrong estimation model, the model might be correct, but it's inadequately estimated. And in all of these cases, my model should yield incorrect estimates and incorrect forecasts for the future, which in turn should lead to a bad measurement of risks. The problem here is that I shouldn't blame this on loss distributions. It's simply the fact that loss distributions and measurement of risk via loss distributions could entail model risk simply tells me as a risk manager, I have to be careful when I pick the model. I need to choose the best model, I need to do it correctly. This is simply the baseline fact here. So these are not arguments against the use, but it's arguments for a proper use of risk models and distributional losses. It's obviously not yet sufficient to just model the distributions and say, okay, this is the distribution. I have this loss distribution. I need to do something else. I need to calculate key figures, ratios, moments. I could use single values, and this is done extensively in the financial risk management class next semester. But what could you do? First of all, you could take this value, the minimum. You could take the mean. You could take the median. You could take the best case scenario, the maximum value. There are pros and cons against and for and against each of these values, and this is what you do in financial risk management. Here you have some examples: the average loss, so the mean loss. You have the variance or the volatility of the losses, the maximum loss, and each and every one of these measures has advantages and disadvantages. And if you take these, for example, you can see several disadvantages. First of all, variance is not negative. The variance is non-negative, so it's zero or positive real number, and therefore, strictly speaking, it's not a real risk measure. For example, if I give you a P&L distribution that looks like this, so you only have profits, this distribution has a positive variance, but we would all agree on this distribution not posing a threat to the company. So a variance or a volatility is not immediately a good measurement of risk, because high variance could also tell that profits are volatile. Okay, the maximum loss is an extreme view on losses. Well, in the end, we are all dead. So if we take the maximum loss, this might be a too dramatic way of measuring and a too pessimistic way of looking at things. It might also be not robust against extreme values. So we might have a bad measurement and one extreme outlier, and if you take the maximum loss, this outlier would bias your risk measurement. So maximum loss, volatility, average loss is probably too optimistic. In that case, we would only take the mean, and we would still be surprised by 50% of the losses that are below the mean, below the median. The most common risk measure in practice is actually the value at risk, the VaR. The value at risk is, does anyone know how the value at risk is defined? If you take a distribution, you take, for example, the 5% quantile, so that 5% probability mass is left of the quantile, and 95% probability mass is here, and this point here would be the 5% quantile or the 5% value at risk. It's simply a quantile. And if this quantile is used in relation to a loss or PLL distribution, we call it the value at risk. This value at risk was introduced by the banks, actually. The banks came up with a risk management tool, an IT-based program that was called Credit Metrics. And Credit Metrics was developed, I think, by JP Morgan. And all banks used Credit Metrics and variants of it. And at some point, back at the start and mid-90s, all major banks used the value at risk to measure their market risks. And at that point, regulators thought, okay, this is a good idea. Let's include this in our regulation. So the industry practice standard became regulatory standard, and it was included in the Solvabilitätsverordnung, the German solvency regulation, and now it's the industry standard, not just in banking, but also in insurance and other industries where risk management is done on a more professional level. However, it's, from a theoretical point of view, it's not the best risk measure. Okay. Now, let's define value at risk. We take the loss distribution FL, which simply gives us the probability that a loss is below a given number, and we Just assume it's a linear function. Now, the valued risk can be interpreted as the maximum loss that is only exceeded with a given probability. Okay. This is the exact and mathematically speaking correct definition. And you can see that it's defined as the infimum of L being real numbers, so that the distribution at point L is larger or equal to alpha. If you see this, you can see that it's simply the alpha percent or 1 minus alpha percent quantile of the loss or P&L distribution. So this is the VAR. Alpha percent, which means alpha percent is here. Usually in industry, in practice, you will use the 1% VAR, the 0.1% VAR, or the 0.01% VAR. So you will not divide 10% and 90% of the losses, but you will only do a measurement at the 1%, 0.1 or 0.01% quantile. You can also use a variation, the mean VAR. You simply take the VAR, subtract the average loss, so the mean expectation of L, and still this is simply a quantile. No? So you should remember that the VAR is simply a quantile of the loss distribution. If you take the risk report of a large bank, you will usually see something like this. This is an extract from Deutsche Bank back in 2006, right before the financial crisis, and you can see they show you in their risk report what risk exposure they have, and here at the bottom you can see the value at risk on each trading day. And the funny thing is that this graph shows you what can you take? What can you take from this picture? What insights? This picture tells you risk management seems to work at Deutsche Bank. They do a VAR calculation, for example, say probably the 1% VAR, and you would say that the loss should be below the VAR only in 1% of all cases. And in this case, there is one daily loss that is close to the VAR but not below the value at risk. So it's even better. Several misconceptions about the value at risk. First of all, this graph also shows you, well, the VAR calculation is not optimal. Why? The value at risk is defined as the quantile so that alpha percent of all losses that are below the VAR occur with a probability of alpha, not with a maximum probability, but there should be 1% cases which are worse than the VAR. So if this is a daily VAR, we have let's say we have 200 trading days or 250 trading days. Let's make it easy. 200 trading days. And this is the 1% VAR. This would mean that 2% daily losses should be below the VAR, because 1% of 200 days is 2. So you should have 2 VAR exceedances. Now, what is the easiest way to come up with a VAR that is never violated? How can you make sure that your losses are never below the value at risk? Because in that case, you would be on the safe side, right?
Just put it to 100%.
Yeah. You could just, if it's in millions, it's not in percent, you could simply say, this is my value at risk here, below here, at minus 120 days. I would simply assume that on each trading day, I can lose up to 1 billion. Well, that's not a very efficient way of doing this, because the value at risk that you calculate is also taken by regulators to make sure you hold enough capital. So this is costly. And the banks have an incentive to calculate the value at risk efficiently and adequately, so to minimize the necessary risk capital they need to hold for their business. But the alternative, of course, just say, okay, I don't want to hold any capital, let's make it this way. This is not very prudent, on the other hand, because in this situation, you would see that, well, the bank goes bankrupt on a couple of days. So you need to calculate your value at risk adequately. And I would encourage you to look at this report from Deutsche Bank in 2007 and 2008. And you can see Deutsche Bank took a pretty high number of hits there. This is 2006, before the financial crisis. Everything was pretty at this point, but 1 year after, value at risk was violated on several occasions. Okay. One theoretical result. I said that from a theoretical viewpoint, value at risk is not optimal. This is because in 1999, some clever mathematicians showed that value at risk is not coherent. It's especially generally not subadditive. What does subadditivity mean? Subadditivity means that for two individual risks, L1 and L2, for example, stock A and stock B, the risk measurement of the portfolio should be less than the sum of the two individual risks. So, for example, if you have a stock and I have a stock, you face a 100 euro loss and I face a 100 euro loss, the portfolio of these two stocks should have a risk that is less or equal than 200 euros, because we will always have diversification. In the worst case, we have no diversification, so we have 200 losses, potential loss of 200 euros. But if we have the slightest bit of diversification, the portfolio should have a risk that is smaller than the sum of the two individual risks. This is a simple idea of diversification. This is subadditivity. And value at risk can come up with situations in which it would tell you, you have 100, I have 100, the portfolio has 250 euros potential loss. And this is the theoretical drawback of value at risk. In some perverted situations for specific distributions, it can give you a distorted view of portfolio risk. And this is the missing subadditivity in several cases of value at risk. Yeah.
When you say diversification, what exactly do you mean?
It means that, for example, the losses you incur are offset by profits I make. Stocks will co-move, prices will co-move, and it might be that stock A moves up, stock B goes down, and you have a diversification effect. So the portfolio should be better off, and the worst case could be that both prices go up and both prices go down. But in that case, if you lose 5, I lose 5, the portfolio shouldn't lose more than 10 euros. And this risk measure, the value at risk in specific situations, would tell you prices go down by 5 and the portfolio loses 15. And economically speaking, this doesn't make sense. But mathematically speaking, it's possible. So this is why, theoretically, value risk has been criticized a lot in the research literature. The alternative is what we call the expected shortfall, the conditional VaR, or the tail VaR. They are more or less the same, except for some minuscule, minor mathematical differences, but expected shortfall is defined as 1 over 1 minus alpha, and the integral taken over alpha to 1 of the quantile function of the loss distribution. This might seem a little bit weird, and actually it's not very intuitive. It's very intuitive if you take on the next slide, if you have an integrable random variable. So if you can take the integral of the random variable. In that case, if L is a continuous loss distribution, in German it's stetige Verteilung, The expected shortfall is very simple. It's simply the expected mean conditional of the losses that go beyond the valued risk. So what is that? That is the loss distribution. Here you have the VaR. And what is the conditional mean of losses that are worse than the VaR? You simply look at this part of L and you calculate the mean, for example. So this could be the expected shortfall. It's the mean, the average loss of all losses that are worse or equal than the valued risk. This is why it's called expected shortfall. It could also be called the expected extreme loss or the average extreme loss that go beyond the valued risk. And you can see this is a different definition. You can also say expected shortfall is a medium or average valued risk, better translation. So it could be seen as an average VaR. And the nice thing is, this is a result that is already 16 years old. The expected shortfall is coherent, it's subadditive, and it also possesses some other properties that make expected shortfall a very good choice for risk measurement. Regulators finally have picked up this notion and picked up this idea, and nowadays many regulations in insurance and banking, they call for the calculation of both valued risk and expected shortfall because regulators want to see both numbers and both figures. Yeah. So this is expected shortfall. Problem is if you take this distribution and here's your VaR and you want to calculate expected shortfall, you have to concentrate on the part of the distribution that is already quite infrequent and where you have losses that are extremely rare. So you need to use a lot of data to get a proper estimation and a proper forecast on expected shortfall. And next problem is you have to do backtesting. What is backtesting? We have actually seen this here with Deutsche Bank. This is backtesting. Backtesting is a process of looking at the performance of a risk model, estimating or coming up with an estimate of how good your model actually was, and then saying, okay, I have to change the model, or I can leave the model as it is. This is backtesting. How do you do this? You usually take a lot of data, you use a lot of data, you estimate the risk model with one part of the data, you forecast your risk measures, and then you compare your risk forecast with the actual data you still have. And then you can see how well the model performed, and if the performance was okay, you can leave the model as is. And if the performance of the model was not good, you can have to change the model. In this case, Deutsche Bank shows you this plot because they want to tell you, look, our risk models are working just fine. If they had losses like this, for example, you would immediately see, okay, this is either the 20% valued risk, which is useless, or the risk model is not working. And if the risk model is not working, they have to adopt a different model or they have to change the current model. This is backtesting. And it's the process of the quality assessment of a model based on historical data. In the case of VaR backtesting, you usually compare the estimated VaRs with the realized losses. Yep.
Does every bank have to use its own model, or can they pool all the data and find a model that fits all banks?
Come again? They have to. The banks usually use internal risk models. It's a tricky question. It depends on what type of risk you're looking at, and under the Basel regulation, banks are allowed to use internal risk ratings-based models, IRB models. So they can use their own risk models, and the supervisory authority has to check the model, and the supervisory agency has to allow the bank to use its own model. The same under Solvency II. Difference is, under Solvency II, most insurers simply take the standard approach and they use a standard risk model. Banks almost all use their own internal risk models. They have to be approved by the supervisory agency, and that also includes proper backtesting. Does that answer your question? Okay. Now there are several standard backtests for valued risk. In particular, there's a paper, and there's several papers by Peter Christopherson and Denise Pelletier, and they came up with several tests, backtests for valued risk. And the basic idea, more or less, is to look at an indicator variable that takes on the value 1 if you have a VAR violation or a VAR exceedance, and 0 otherwise. And then you have something like this. And the first idea is to look at what? If this is the 5% valued risk, what do you need to compare? 1, 2, 3, 2, 4, 6, 8, 10, 12, 13, also P bar, the probability of a VAR violation in the sample is 3/13, and it has to be compared with P hat equal to 5%. So is this adequate? It must not be too small, it must not be too high, so it should be around 5%. This is the first basic idea when it comes to backtesting valued risk. And the second idea, what could you also backtest? Given that the number of VAR violations is correct, let's assume we have the 1% valued risk. No, that's not a good example. Two distinct situations. First one and second one both have the same number of violations. But the second one shows a clustering of exceedances. And this is not good. For valued risk, we would assume that in time, exceedances are independent. And the Christopherson-Pelletier test tests for both the correct number of VAR exceedances and temporal independence. And you can do this by a hit test. I know it's called a run test. So you check for two situations which you do not want. First one is a clustering, and the second one is systematic changes. This is also non-random, of course. So these are the two extreme points here. Okay. This is risk management, risk measurement, and backtesting. Now let's quickly turn to hedging strategies, because this is also important. At this point, you know we have different risk exposures, you know how to measure risk exposure, you've calculated, given a certain position, you now know you have a valued risk of, say, 2,000 euros or 2 million euros. So what can you do to avoid these risks and how to deal with these risks? Risk avoidance, diversification, transfer, reduction, and, well, assuming the risk. Not a good translation. It's a German Risikoübernahme and Risikoaufnahme. How can you avoid risk? In some cases, you are able to completely avoid risks. For example, if you refrain from engaging in a contract, you can, of course, eliminate risk altogether. If you are not willing to do an OTC contract, you have no counterparty risk. If you do not grant a loan to a certain customer, you have no risk at all. For insurance companies, risk avoidance is very important because you have underwriters who have to underwrite each contract, and in case the underwriter deems the risk to be high, they can avoid the risk altogether. So in some cases, loans will not be granted and you have no risk at all. Second idea is risk diversification. In credit risk management, for example, you can grant loans where you have a probability of default that is stochastically independent of the default risk of other parties. So companies and banks will usually look for risk diversification by not putting all eggs in one basket. If you only grant loan in one geographical area, you are prone to suffer from cluster risks. And especially insurance companies know this, and they will try to diversify their risk not only via customer groups, but also geographically. Market risk area, you can use correlations and dependencies between different financial instruments. And the problem, of course, is that diversification of business and credit risk might also lead to higher foreign exchange risk. So if your idea of diversifying market risk is to go overseas, you immediately have additional foreign exchange risk. So this might not work as well as you've planned. And operational risk, how can you diversify operational risk? Not pretty much. You could think of putting up plans when you think of industrial companies in different places, but again, you will only have one headquarters, and if the operational risk is related to your headquarters, you cannot diversify it. You can transfer or sell risk. In credit risk, you can sell or assign receivables, you can securitize loan portfolios, you can do a credit default swap, in which case you will transfer default risk to the counterparty. You can close open positions, for example, by selling securities or by netting derivative positions. And in operational risk, you can simply buy insurance. If you have a fire risk, buy insurance. So it's transferred. It's not diversified and it's not avoided because the real risk still exists, but it's transferred to the insurance company who is offering you fire insurance. Risk reduction, risk limitation. In some cases, you can limit the amount of credit lines granted. You can enter into an offsetting transaction, which we call a hedge transaction. And usually for hedging to work, you need financial derivatives. These are securities whose value is derived from an underlying security. In many cases, stocks or interest rates and foreign exchange rates. Okay. And there is one small example here for hedging, and I want to show you this, how this works. Even if you have no knowledge of derivatives yet, you should be able to understand this. So let's assume we want to hedge an existing spot trade, existing spot position. We use a one-to-one put hedge. A one-to-one put hedge consists of hedging our underlying asset position of N securities by buying the same number of puts on the same underlying. So you have, for example, 5 stocks of BMW, and you buy 5 puts on BMW. Does everyone know what a put is? And if not, who can explain what a put derivative is, a put option? It's the right but not the obligation to what? Sell a certain number of underlyings. In German, it's a Verkaufsoption. It's a put option. You can sell a certain number of underlyings at a strike price, and you buy a number of puts. So you are the owner of the put, and you can sell via the put. So your wealth position then equals in T at maturity. This is important. At maturity, you have the stock. You still own the stock. You still own what the put is worth at T, but you need to pay out the put price at T equals to 0. So at the start, you have to buy the put, and at the end, you have the stock. and the value of the put, but previously you have paid out the price for the put because you need to pay for this hedge. You need to pay for the derivative. So this is equal to ST, the value of the stock at the end, at maturity, plus what is the payout at maturity of a put. Now you have two options and two situations. First of all, assume that the stock price is higher than the strike. So you can sell for 100, and on the market you can sell for, let's assume, 150. Will you exercise the put option? No. PT at maturity is 0. If ST is smaller than X, you can sell for 100 via the put option, but you could only sell for 80 on the market. In that case, what is PT? Yeah? 20. So, in other words, it's X minus ST. And here you can see you will only exercise in the latter part. So the value of the put option at maturity is the maximum of 0 and X minus ST. And this is a typo. Of course, this is minus P0. And if you combine this, you can see that your wealth is X minus P0 or ST minus P0. And you can see this on the plots here. You have a stock. You can also see why it's called a linear asset, because the risk and the wealth of the position increases linearly with the price. The put option is a non-linear instrument, and the joint position with the one-to-one put hedge shows you that you are able to minimize this loss potential actually to this. You are able to turn this part of the stock investment, and you have some hedging for extreme losses in the stock. But of course, at any point, this is the price you have to pay. If the stock increases, you will always have to pay for the put hedge, for the put option. So you're willing to put away some of your profit, for sure. This is deterministic. And in turn, you get some security and some safety when the stock prices plummet. So this is the effect of the one-to-one put hedge. And here you can see the P&L function of the one-to-one put hedge. Actually, if you have to buy the stock in the first place, here, of course, the worst case is you lose everything. You buy the stock and you lose everything. It's worth nothing. And with the one-to-one put hedge, even in this scenario, you would not lose as much as with the stock investment on its own. And this is the one-to-one put hedge. Now one would think, why should I be interested in doing this hedge contract and this hedge position? Now this is the case in which you want, on this plot you can see, okay, if I buy a stock, why would I be interested in a hedge? Well, you can minimize your potential losses. You are willing to pay a certain risk premium and a certain insurance premium to be on the safe side. You know that your maximum loss is bounded by X minus P0 minus S0. And in that case, you do not have a maximum loss of S0. This is a one-to-one put hedge. This one-to-one put hedge leads to an asymmetrical gain or loss position at the end of the term. If you use alternative strike prices, you have a trade-off between increased hedging against price losses and reduced participation in price gains, in appreciations. With a put hedge, hedging can also take place during the maturity and during the length of the contract. American put options, in contrast to European puts, have a slightly different mechanism. What is the difference between a European and an American option? Yeah?
The American option, you can use it anytime.
Yeah.
The European one, you have to wait until...
If you buy a European option with the length and a maturity of 1 year, the decision whether you want to exercise your right is only possible at the end of the contract, at maturity, in 1 year. For an American option, you can exercise this right at any point in time until maturity. So if you use an American option, it's a little bit different, but again, you have a hedging mechanism and hedging effect. What are the premises and assumptions you have to make? The first prerequisite is that you need a corresponding put option to be available on the market. For example, if I want to hedge against the BMW, if I want to hedge the BMW stock, I need a put option that I can buy with the BMW as an underlying. If that's not possible, you have what we call a cross-hedge risk. For example, you can take a put option on Daimler and use it to hedge a BMW stock, but of course the underlyings do not match, and this would lead to a cross-hedge risk. If the hedging horizon is T, puts with at least the same term must be available. If you have to buy another set of put options, you have additional transaction costs. And of course you have to consider position restrictions, exercise limits, and it's not possible and not a solution to all your problems by simply buying a lot of financial derivatives. Financial derivatives are risky and they are heavily regulated, so of course, banks use financial derivatives, and I might have told you this, that if you look at the financial balance sheet of Deutsche Bank under US GAAP and under IFRS, actually the balance sheet looks totally different due to financial derivatives. It's 1 billion under IFRS, and it's 1 trillion euros under IFRS and 2 trillion euros under US GAAP, because they don't allow netting and offsetting of derivatives. Yeah. So transaction costs, exercise limits, and position restrictions need to be fulfilled. Also, you can do risk assumption, and you can assume risk. You will always want to assume a certain position and a certain percentage of your risk. Why? At the end of the day, you are still a bank. You earn money by assuming credit risk. If you want to diversify all risk, you will only earn, in a competitive market, you will only be able to earn the risk-free rate, and that's not what your stockholders are looking for. You want to bear some risk, then you have to face it. Yeah? Okay. Yeah, this is the last slide when it comes to risk management. Do you have any questions? Yeah?
Yeah, what's meant with the exercise limit and the position regulation?
In some cases, you are not allowed to engage in heavy derivatives trading. For example, certain companies are not allowed to hold all types of derivatives. Some of them are regulated. I'm thinking of banks, insurance companies, pension funds, etc. So this is the part of financial instruments and trading at which supervisors have a close look. And in some cases, these derivatives are regulated. You also need to hold capital. So this might not be, you might not be able to buy as many derivatives as you would, for example, like to hedge all positions. And in some cases, you have exercise limits. That means you cannot simply, if you are a trader, you cannot simply buy derivatives in an unlimited manner. So each trader has a certain limit up until which he or she can trade and also do hedging, but at some points it doesn't make too much sense. Yeah? Yeah?
And why would you use the one-and-one hedge and instead of just using a stop loss and then a rebuy at 80, for example?
Oh, this is simply a small example how this hedging effect would take place. So, because I know most of you have not heard and have not attended the derivatives lectures with Professor Schumacher, and I would assume that those students, those of you who have never heard a word about financial derivatives, are not or they probably do not. You probably do not know the mechanics of hedging yet. And this is one example. You can do a stop loss, and you can do a 1-2 put hedge, and other variants that might even work better. But this is the simplest way of using an option together with an underlying to get a hedging effect. Yeah. Additional questions? If that's not the case, I will not start the regulation slides. You will find those on the website, and I will stop here. So this part is relevant for the exam. And do you have any questions?
So lecture 8 is relevant for me.
Yes, 8 is relevant. You did not expect this. I can see this. This is the part where someone of you can make him or herself very unpopular by demanding that I continue. I would assume that each and every one of you will have a close look at the regulation slides later on. This is also part in the master's degree. We have financial market regulation there as a master's class. Bank regulation is, of course, important. You have seen some aspects of regulation: capital requirements, risk management, bank run scenarios, deposit insurance. This is all part of bank regulation, but you will see this if you continue doing with your studies in banking. You will see this at some point anyway. So, any questions? Yeah?
Well, do you have some tips or advices regarding the exam? Because, to be honest, currently I'm not that sure about what to learn. Because
You can have a look
we
at
had
the...
like 700 slides or 600 slides. And of course, we took some notes during it, but
you can have a look at the previous exams. The exam this semester will look quite familiar to the ones already on the website. But if you have no further questions, thank you for your attendance and for your attention, and good luck with the exams. Thank you.